Welcome to Kitchen Table Finance.
Hey, Dave, how you doing today?
I'm doing well, Nick. How are you?
Doing well. It's Friday. It's actually feeling a little springy out there. Maybe even touching 70 degrees today. So I'm not going to complain.
Yeah.
It's
Fun.
we're recording this on a Friday when the markets close. So I got a little bit of wiggle room between what I say and what changes. Right.
Right. Yeah. Not as much of a moving target. We're almost done with second winter, and we're gonna roll with that. Yeah.
So today's episode, Dave, is our quarterly market review for the first quarter of 2025 and also taking a look at potential outlook for the rest of the year in the second quarter here. So we enjoy doing these every quarter. With that in mind.
You're telling me I have to enjoy this?
Fair enough. We don't always enjoy it, but it is important to kind of know what's going on. But it's also important to remember that what happens in a quarter shouldn't impact your long-term outlook. And you should always be focused on the long term and not necessarily the short term. But also, we feel it's beneficial to kind of know what's going on to be able to process it so that you don't get too emotionally charged and potentially make some mistakes, right?
Right.
Per usual, with our friends from East Bay put out their glass half full, glass half empty, just kind of looking at, what's potentially going well and what potentially isn't going so well, and kind of taking a look at it from both approaches, right?
Right. And, we always start with the glass half full. And I think obviously we've been going through a lot of tumult and very volatile times. And so it's important to remember that there are positives out there and there are things that are potentially, good for the economy and good for the markets.
Yeah, we actually had a meeting with our friend Mario from East Bay this morning. And one of the things that he said that stuck with me is, the money has to go somewhere, right? Something's always on the positive side, even when there's a lot of negative, right? And so that is why we believe in global diversification and holding things that, when one thing's going up, the other one might be going down, but that's by design, right?
Yeah.
And it was a big check in our favor this first quarter, right?
Right. I guess to kind of frame all this up, the main question we're getting for clients is, what do we do now? And the answer is same thing we always do.
Yeah.
We maintain diversification. We remember that we don't know what's going to happen in the short run, and the long term will take care of itself.
Yeah. So global diversification boosted returns for U.S. investors in the first quarter. And, it's funny because we had a couple of years where we had those questions about, should we just own U.S. stocks, right?
Right.
Should we just own the S&P 500?
Right. It's interesting how that has helped, diversified portfolio returns while the headlines were being captured by U.S. large company stocks falling drastically during the first quarter. U.S. large company growth was down 10%, where it had been up huge a few years prior. We actually saw international stocks, at one point through like mid-February, I think we were up 10% on international holdings. Yeah, here we go. Closed out the quarter with U.S. International large cap being up 6.2%, international large value up 10%. It really did provide a little bit of support when the U.S. markets were so lousy.
And for the first time in a long time, I believe that international has been up 10% or more on the U.S. For a pretty long time. So shout out to those. Every once in a while, we diversification wins, and we feel pretty good about it, right?
Well, diversification always wins and always loses. That's part of the part of being diversified. So anyway,
that's a good point.
This next one I think is interesting. So one of the things that's come out, in the last towards the end of the quarter and in first quarter was that Germany is drastically increasing their defense spending, and the UK is spending on housing and infrastructure. And the yin and yang of these things, as U.S. policy has put some pressure on Europe to maybe take care of some of their own defense and some of their own internal needs. their spending and their government stimulus has helped the international stock markets and may help create a little bit better balance in that respect.
Yeah, so good signs coming out internationally, and that's kind of what we're seeing and how well international stocks have been doing.
Yeah.
So that's a good sign. In other, related good news on the U.S. front, the macroeconomic data suggests that the labor markets are still solid, which, I think a lot of people are potentially surprised about because, all of the news about the U.S. is bad, but for all intents and purposes, the labor markets remain very resilient and very strong, right?
Yeah, so far, and now that data is a little bit stale. We're waiting, on March
Sure.
March numbers here, and I know, since the quarter end, we've seen some layoffs announced and potential layoffs announced. So, and I don't believe a lot of the government reduction in force has been factored into those numbers yet in February. So we'll see how that plays out. But the important thing there is we're starting from a very strong labor market. Not going to try to predict, but it seems like we're going to see a weakening of the labor market. It's different when you're starting with 5% unemployment and going to 7% than starting with very low unemployment and going to a slightly worse place.
Yeah, for sure. Unemployment looks like 4.2% right now, so
Yeah.
still in a very historically low, right?
Low, right.
Similar thoughts on inflation. It actually
Yeah.
declined to 2.8% on the last reading from February of 2025. So that was one of those things with the tariff talk of what does that mean for inflation? Our price is going to go up, and like you said, this data is a little bit stale. But it's still in the right direction, which is a good sign, right?
We're starting below 3% inflation. So if it worsens from here, it's again not as bad as if it's worsening from 5% or somewhere
Right.
already middle range or worse.
For sure. So on the other side, the glass half empty side, Dave, uncertainty, I think, is the word of the year so
that's
far.
The key. Yeah.
Right.
Yeah.
Especially as it relates to tariffs and the impact on the global trade wars, which is a
Yes.
daily changing thing.
It's been a wild ride, particularly since the end of the quarter, the first couple of weeks of April here, but still waiting to kind of see how this is all going to play out. That has had an impact on U.S. consumer sentiment and confidence. People are very worried about whether they're going to be able to continue spending and continue keeping on as normal. So
Yeah.
we're seeing that start to show up in consumer sentiment numbers from February and March.
Before we go into the consumer sentiment, let's take a second and talk about the tariff story because
Sure.
there's some rationales for tariffs and the kind of the reasoning, and then there's the potential negative implications. The reality is we just don't know what the implications are going to be because it's been, and even Jerome Powell, the Fed chair, came out and said, we haven't seen this since like the 1930s, and even then our economy was so different. Like
Very
we just
different.
have no idea what this is actually going to look like, right?
Right.
And so there's just a lot of uncertainty around that. And so if you look at it from those two halves, right, the kind of the rationales are protecting domestic industries, influencing another country on policy issues, which we've seen and heard a lot of, right?
Right.
Generating government revenue and encouraging local production. Those are kind of the,
that's the hope. Right.
Yeah, that's the hope. Exactly.
Yeah.
The hope is that we can accomplish these things through tariffs, right?
Right. On the other side.
Yeah, the risks and the negatives of implications are trade war. What does that mean, right?
Yeah. Yeah.
Tit for tat and potential economic slowdown. The downside of the protectionist tariffs is that U.S. companies feel a little bit more able to increase their prices and still be under a company sending their goods and services over here and make more money without doing more work, potentially. And the lack of competition there potentially is a potential problem, right?
Right. It just can have a distorting effect on how capital and decisions are made.
Yeah. Well, and it's extremely challenging because of the uncertainty of here today, gone tomorrow. These decisions that businesses are faced with are not decisions like, hey, we're going to flick on the lights at the new U.S. plant. Like it's a we
Right.
need to invest $5 million to build this facility in the next 3 years decision.
Companies do the same thing as we do as individuals. When they don't know what's going to happen and you're worried, you tend to not spend money.
Right. Yeah.
And try to, you kick decisions down the road. Let's wait and see what the rules are going to be. There's that big concern that we're going to see a big drop off in spending, both on the corporate level and the individual level here until this gets sorted out. It's going to chill things.
And you can kind of see that too in like the frame of, in the context of the market, when we decided that we were doing tariffs and we were hard and fast and that wasn't going to change, the market went down because all these companies were faced with the realization of, like, we have to make these decisions now, right?
Right.
And then we had a 90-day pause and it was like, okay, we don't necessarily have to make these decisions now. We can figure things out for a little bit before we have to start making those decisions. And, the stock market had one of the best days ever, right?
Right.
And through all of this, no surprise, consumers are feeling the same way, right? We've seen that consumer sentiment and confidence decline. We've seen a lot of people, your alma mater and their consumer sentiment survey, Dave, from the University of Michigan. Consumers are kind of faced with those same decisions of, do I go out and buy the thing and do the thing, or do I hold off and wait and see where the chips fall before I make some of those decisions, right?
Yeah.
The good news on that is it really hasn't necessarily affected consumer spending at this point.
Not yet.
Right?
No.
Like, people are worried, but they're still going out and spending. But does that change? And when that changes, that's a major potential impact.
So we're basically looking at a situation where the U.S. stock markets are off to a really not great start in Q1 and have been heavily impacted by big drops in those stocks that had been, we were calling them the Magnificent Seven last year. I guess they'll replace Magnificent with some other epitaph here going forward. But that's really been, the big yin and yang in the market, is how fast those things were flying up over the last 2 years versus how precipitously they have dropped over the last 3 months.
Yeah. So that definitely having an impact. And then, the last point here is there is some growing skepticism about the timing and feasibility of the Fed rate reductions.
Yes.
We talked about this a little bit last quarter, where, kind of the goal of not goal isn't the right word. Kind of the market expectation was for 4 rate cuts this year.
Right.
And then when we started talking tariffs, that went down to maybe 2. And now Jerome Powell came out and spoke and said, we're perfectly happy to wait right now.
Like corporations and consumers, they've got to wait and see how this is going to sort out. The Fed's got two mandates. Keep the economy going, and the measure there is usually unemployment. So keep unemployment low and keep inflation low. And those two things conflict, right?
For sure.
A growing economy is going to have a very fast growing economy is going to have high inflation and low unemployment. A slow economy is going to have low inflation but high unemployment, and they're trying to steer that middle path. And they're coming under a lot of pressure right now to lower interest rates in the face of potential slowdown in the economy. The things that would be slowing the economy down are also potentially inflationary in the form of tariffs and tax cuts, et cetera. So what do? You can't lower the interest rates and stimulate the economy to create more inflation, but you've also got to make sure you don't let things get too slow so that unemployment spikes. So what do? You wait and you see what the numbers are going to show.
Well, that's the big thing, right? And the hard data numbers have remained pretty strong. Like we talked about, unemployment is still pretty low. Inflation's, sticky, but it is kind of going down and in that, normal-ish range. And so until those things potentially start changing, or we see those things change, we're probably not going to see the Fed do very much until some of this, gets sorted out in terms of what these tariffs look like and what the and really what the effects look like and what the economy looks like in the aftermath, right? So right now the Fed rate is at 4.25 to 4.5, remains their policy range as inflation and the labor markets have not shown signs of collapse at this point.
Right.
So we talked a little bit about consumer sentiment, the number on that, 65.2. And we also talked about 10.9% as the international large cap stock performance outperformed the U.S.
Right. And, as far as consumer sentiment goes, that's a pretty high number, but it's still below, what we typically see during recessions.
Mm-hmm.
So, it's a number of 80 would be considered a pretty strong recessionary indicator.
For sure. And this is as the end of the quarter, but a 60% MSCI, ACWI, and 40% bond portfolio holding would have returned about a negative 0.3%. That's a little bit worse than that, but not, I mean, if you think of everything that's going on, you're probably feeling pretty good about that, right?
Right. Very few people hold, a portfolio that's going to be perfectly 60% all cap world index and 40% global bond aggregate, but it's a pretty good proxy for a moderate growth portfolio, right?
Mm-hmm.
And similar position, like as a benchmark to where a lot of retirees are. And things are worse now in terms of the markets than they were on April 1st or March 31st. But for all practical purposes, most people thought they were way down. And if you're a moderate growth portfolio holder with diversified international stock and some bonds and everything, you were pretty much flat or pretty close to flat going into the end of the quarter, despite the headlines, despite large cap US growth being really beaten up and the headlines making it sound like the markets were in financial crisis range. You were probably pretty close to even. And here we are 2 weeks later, and I think you're still probably, within 3 or 4% of even.
Yeah.
So, and it's not that, like, I never want to see anybody lose money, but that's within the realm of normal market movements, right?
Right.
We have
For
not
sure.
seen anything drastic in terms of what's happened with portfolios yet.
Yeah.
So we got to kind of keep perspective, and it's easy to lose that when the headlines seem so wild and crazy.
Yeah, that's a great segue because I was just pulling up the one of the charts from East Bay about past downturns and long-term performance. There's several different versions of these out here. This happens to be my favorite recent one that I've seen in a while, but it essentially plots the growth of the S&P 500 against all of the different times we've had a 5%, a 10%, or a 20% drawdown, and it is littered with those drawdowns happening throughout the years, and yet the market keeps on going up and to the right. It keeps growing over time, and that's really kind of how you need to think about this is, yes, 5% drawdowns happen quite frequently, 10% a little bit less, but still a lot of them, even 20% happen quite often, and yet the market continues over the long term to grow up and to the right. And these are the things that you need to be focusing on right now, because I guarantee you every single one of those drawdowns felt like this is new, this is different, this is something that's going to make things not go the way we think they will. And they were all wrong.
Financial advisors make a lot of hay with the mountain chart, as it's sometimes called, of the long-term market returns. But really, I mean, just looking at this and remembering in the moment, like looking at what 2009 looks like on a chart that goes back to 1926 and goes forward to 1920 or 2024 now, kind of makes me just chuckle at just how bad that felt at the time. And how do we ever recover from this? And our clients still, how are they even believing what I'm saying right now? And then you back up and look at like where we've come since then and what the market did before that. And it's just a little check mark in the line now.
Yeah. Yep.
So,
perspective. We will post this in the show notes so that people can take a look at that. And just, it's a great reminder of keep in mind what's important, right? And keep that long-term view, because this too shall pass. So keep your heads up out there.
Yep.
With that, Dave, always a pleasure. It's been a tough start to the second quarter, but hopefully this provides some guidance to our listeners out there, right?
As Mickey Redmond would say, there's still a lot of hockey left to play. We'll see where we're at. We'll see where we're at on July when we do this again.
I like it.
All right.
I will see you there, my friend.
Okay.
Until next time.
Yep.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.